Morning, Steve.
Morning, Chris. Great day to get an economic update.
Like a bad rash, we're back.
Exactly. So for those of you who are joining us, and I see they're streaming into the room here, I'm Steve Rosansky, President and CEO of the Newport Beach Chamber of Commerce, and I want to welcome you to our June edition of our Finance and Economic Update. We've done a series of these over the last year, probably half a dozen maybe, since the pandemic began. We've had Professor Schwarz here, Christopher Schwarz, as our presenter. He's done an excellent job in guiding us through the shoals of the financial and economic shoals of the pandemic. And we've appreciated those updates. I know I've received many favorable comments from my chamber members, and we're glad to be able to present this to you today as well. This edition is special. As we move forward, initially it just started as our chamber and the Irvine Chamber hosting this, and slowly we've accumulated other chambers that have wanted to present this valuable information to their membership as well. And today I can say that we have 28 chambers of commerce and finance organizations as co-sponsors of this economic update, which is a new high. It's probably almost double what we had at our last one. So I think the word's out, Chris, that this is definitely an e-ticket for those who remember what e-tickets are. And I don't mean economic ticket, although it is. But certainly it's been valuable, I think, for me and our members to have this information to help us through our daily lives and our business lives, because there's certainly been a lot going on, and there will be a lot going on in the future. I do want to say that normally we host an economic update in person every year. We will be going back to that. Thank you, Governor Newsom, for releasing the state on June 15th. We're back 100%, no mask, no physical distancing, and no occupancy limits. So we've already reserved October 5th at the Balboa Bay Resort for our 2022 economic update. Chris will be our speaker there, our keynote speaker, and we plan on picking up another one or two additional speakers. That will be a luncheon event, so plan to be with us for a couple hours, and more information will be forthcoming on that as we move into the summer and we finalize our plans for that event. But last time I think we had about 350 people there. We virtually sold out, so I expect an even bigger crowd. So make sure you make your reservations early. And so with that being said, I will mention that Chris is going to be making his presentation over the next hour. About half of that will be a series of slides that he's going to run through, and then he's going to stick around for a Q&A session afterwards. We're going to handle the questions at the end. So if you do have a question that you want to ask based on the information that you've heard or just something else that you've been thinking about, Chris will be here to do that. But please type those questions into the Q&A box, not the chat box. Please put them in the Q&A box. So with that being said, I'll just read a little short biography on Chris, and then we'll be off to the races. So Professor Chris Schwarz has been at the Paul Merage School of Business since July 2008. Prior to arriving at UCI, he received his PhD from the University of Massachusetts Amherst. During his doctoral studies, he was also a visiting doctoral fellow at Yale University's International Center of Finance in 2007, and the advisory editor at Review of Financial Studies, at the Review of Financial Studies. He received his BS from Babson College in Wellesley, Massachusetts. Prior to receiving his doctorate, Professor Schwarz worked in the IT industry, writing custom applications for medium-sized businesses. Chris has written numerous papers and articles in the investment and finance fields and has won several awards for excellence in teaching. Currently, he is the director of the Center for Investment and Wealth Management at the UCI Paul Merage School of Business. So with that short introduction, I shortened it up a little this time, Chris. I didn't want you to get a big head. I'll let you take it away, and I'll see everybody when I get back to help with the Q&A.
All right, thanks a lot, Steve, and looking forward to October. I got my Hawaiian shirts already picked out for the event, so looking for that in October. So today I'm going to give a forecast. It's going to be a little bit different than if you've seen some of my recent forecasts. I'm going to kind of be a little bit more forward looking now that I think the economy here is pretty solid footing, and I have some thoughts on kind of the next cycle as we go through things. So I think today I'll have a lot of new thoughts for you that haven't really been on any of the prior forecasts. So if we kind of look back on the COVID period where we are today, I mean, obviously 15 months ago we thought the end of the world was happening, but this famous scene here from Weekend at Bernie's, everything go okay up in there after Bernie was dead, and she had like never been better. And I feel like a lot of people after the COVID period saying today, economically and financially probably have really never been better than they are right now. Because if you look at restaurants, they'll be back, and they are back, just like the Terminator. Of course, I don't think Arnold can run for governor again, so he's not going to be our replacement if Newsom gets recalled. But if you look at the open table data here, you can see we went from 0 to negative 100. Basically, everything was closed. You kind of have this U here, and then you guys remember in January we had the big COVID spike, and we're all the way back. So if you look at kind of open table data, our restaurant occupancy is close to what it was before. The caveat here is this is only for restaurants that are still open, and of course we lost a number of restaurants, but restaurants are looking back. A movie that you probably haven't seen is Strange Brew with Bob and Doug McKenzie, and of course everyone right now is trying to take off. If you look at flying data, you can see here that TSA traffic, so this is foot traffic going through TSA, is going back up again. And I'm going to guess in probably 3 or 4 or 5 months, we'll be back to almost regular traffic that we were before. In fact, I'm sure you've been reading about the TSAs actually having staffing problems because so many people now are going through TSA. We got money coming from everywhere. So a year ago, everyone was worried that the state of California had a $50 billion deficit or something like that. And of course, now we have 76, maybe even $100 billion in excess money between the fact that things shut down, but the tax revenue kept coming in from the stock market. Of course, we got a lot of government assistance from the federal government, and now people are going to be getting stimmy checks, as the kids call them, from California, not only just from the federal government. The economy is going crazy, right? GDP this quarter is probably going to be up 10%, which is, after 6.5%, that puts us up almost 8% for the first half of the year, just something that hasn't happened for the last 30 or 40 years. And so you just look at everything, it's coming up champagne and strawberries for us, right? COVID cases are down to about 13,000 a day from 300,000 at the beginning of the year. So COVID's pretty much gone away. Vaccines, are falling here simply because a lot of people already have vaccines. And some people don't want to get vaccines, which is okay. But I think eventually everyone's going to be forced to get a vaccine here once there's official FDA approval. And you can see here the number of cumulative doses, actually over 300 million now. This chart's a few days old here. So everything's coming up great. Really, there's nothing to complain about. I could just sit here and it's kind of like, we're counting the cards in the deck here with Rain Man, where just, no matter what we do, we're making all the right moves and things are going great. But, this actually makes me a little bit nervous, right? When things are going so great, because everyone's super optimistic about where we're going. And of course, I'm always thinking about, it's a little quiet. It's a little too quiet. In fact, I actually joked with one of my friends. He's like, what are you going to talk about on the forecast? And I said, it's kind of sort of boring out there a little bit. When it comes to the economy, we have one thing which we're going to talk about, that's inflation. But otherwise, it's kind of a little quiet out there. And I thank God for the meme stocks every day, just because they help, keep things a little bit more entertaining. And so I'm thinking about now that the recovery is going, I'm thinking out a little bit farther in the future, right? So now, we're in 2021. I think things are pretty much set here. It's June. I'm starting to think about 2022. What's the end game of this particular cycle going to be? And thinking about, one day Jerome Powell, he's the Fed chair, if you didn't know that, the guy that controls interest rates, what's going to happen that makes him, be like the Big Lebowski after he lost all the money and he thought that the girl was killed. I can't worry about that, man. Life goes on. What's going to be the cause of him just to throw up his hands and say, there's nothing I could have done. No one saw that one coming, like Greenspan and some other Fed chairs have to do, because our track record says that as good as prosperity is now, and it looks like it's going to be for the future, we are 100%, this is Notting Hill, by the way, 100% going to fail at keeping this success going, right? 100% going to fail at keeping this success going. And that's the question is, how are we going to fail? All right. And so what am I worried about? So I don't want to overemphasize that the economy is not doing well. The economy is really doing well. All right. But there's a lot of things that kind of also worry me about the economy, because to a certain extent, I think people are thinking about perfection. All right, people are thinking about perfection. And so I'm trying to think about the things that are kind of pull us back a little bit from where we are. And there's many things on this list I don't have, but you can see there's quite a number of things that actually can pull us down. And so I want to spend some time talking about those today, instead of just saying, hey, things are going to be great for the rest of the year. That's not just a forecast at this point. It's kind of what's coming at the end of the year or 2022 that, kind of I'm thinking about here. So the first one's a quick point. And that's, I think people are probably overly scared about COVID, right? So we had kind of at the beginning where we had a large group of people who weren't that concerned about COVID, and we try to get them to be concerned. And now we're kind of at the point here where I think people are really kind of worried about COVID, when statistically there's no reason to. So, I made a LinkedIn post about this. We're really bad as humans at dealing with low probabilities, right? Your probability of dying on a plane is like 1 out of 300 million per year. But people don't know how to kind of think about 1 out of 300 million. So they either go to, well, it's going to be like 1 out of 20, right? They think it's really high, or they just put it to 0 and they don't worry about it. And so I thought it would be good to think about what your probability of dying from various things are in the United States, and then compare it to COVID, right? So, just to put this in perspective, right? Your probability of dying for COVID here in the US, and by the way, just the way of calculating these is super conservative. In other words, these are way higher than they actually are. Like I'm assuming if you get COVID, you have a 1% chance of dying, even if you have the vaccine, which is unheard of. But pretty much your chance of dying of COVID across the US right now is the same as dying in some kind of accidental poisoning, which does not seem very likely. Your probability of dying in California of COVID is the same as dying in a car accident this year. And your probability of dying of COVID here in OC, we only have about 20 cases a day, is basically the same as walking across the street, right? So your probability of COVID is really low. And so I kind of want to start emphasizing that, when things do reopen on the 15th, there's no reason to be scared, right? We've talked so much about COVID. And yes, a lot of people have passed away, and that's been very unfortunate, but really kind of these vaccines have been lifesavers and life-changing for us. And we really should take advantage of them. The second thing I'm worried about is there too much stimulus? All right, just too much stimulus going out there. And I think the easiest way to show you is there too much stimulus is to look at this chart. So this is the percent of government spending as of GDP, right? So GDP is the size of the economy. This is telling you how much of the economy is going to be spent by the US government. And as you can see here, over the whole period here, it's averaged about 18%. And just recently, before COVID hit, we were actually only about 19% of the economy was government. And basically right now, based on the budget now and what has been proposed by Joe Biden, he basically wants to take it to 28 to 30%, right? So he wants to increase government spending 50% over our baseline of where it was when we got started. I'm not making a political point about if we should or not. I'm just saying that 50% is a huge, huge pump out of government stimulus. Not, just not what's already happened this year, but he's talking about another $6 trillion budget next year, and the year after that, and year after that, and year after that. So we're talking a sustained level of stimulus that's, something that we haven't seen in a long time, right? And so of course that's a lot of stimulus, and most of it's not going to really be paid for a while, right? So this is inflows. This is basically taxes that we pay as percent of GDP. So one, you can see it's lower than outlays because we run a budget deficit. But you can see here that taxes really aren't going to increase meaningfully for a couple of years, but also you can see taxes are supposed to jump 50%. And if there's one thing I know for sure, that taxes are not going to jump 50%, right? There's no possible way that's going to happen, right? So there's a lot of stimulus that's probably going to enter the economy at least the next 2 years before these taxes take hold. And if these things pass, which unfortunately or fortunately, depending on your political view, looks like it's getting a bit lower with what's going on in Congress, that's going to add a lot of stimulus to what's going on for us. I should also note that probably if we're going to pass stimulus, it's now or never. So this is essentially what happens during the midterm election. So midterm elections are next year, 2022. And almost every single year, very few years, the incumbent party, so the Democrats in this case, are going to lose seats in the Senate, and they're going to lose seats in the House. And obviously they don't have to lose 1 or 2 seats in the Senate for them not to have Senate control. And of course, once McConnell gets control of the Senate again, that's going to be the end of any chance of passing these things. All right, so this is kind of like the last ditch effort here for the Democrats to get their agenda through. It's kind of like when Obama took office in 2009, they had that 2-year window before the Tea Party people took over. We have basically the same 2-year window for the Democrats here to change things in Congress. All right, so let's say the stimulus does pass. So what's my real problem with it? And my problem is, it's pretty much like Finding Nemo here. So you might remember the scene from Finding Nemo where Nemo's in the water and you can see there's, a billion seagulls fighting over who's going to get to eat Nemo. And that's kind of the issue here, right? So if we keep passing all this stimulus, we're going to end up in a situation, well, you know what? Everybody's trying to eat the same natural resources, right? So this is some commodity prices that have been going on here over the last year. You can see grains, wool pulp, lumber, copper, all these things have been skyrocketing up 60% so far this year. That's nothing compared to lumber. So this is from my friend Bill McBride at calculatorblog.com. You can see lumber prices started the year about $400 and it got up to $1,600. Even now it's come back some. It's still almost up 200, 300% for the year. I have a friend that's in commercial real estate. They got an apartment loan for $35 million and they had to stop building the apartments because their lumber price went up $2 to $3 million and they just can't afford it. And you see the same thing going on with home builders now. Basically, they're not building houses until the last possible second because they're so worried about these lumber prices, right? So lumber prices are going crazy. So we have all these people fighting over resources, and what's happening is we're seeing a huge spike in inflation right now, right? So this is something called PCE, all right? So there's a personal consumption expenditure inflation measure. And if you look at that, this is including food and energy. You can see it's just about the highest it's been in the last 30 years. All right, so there's a little spike here if you remember when oil prices went up to like 120, 130 back in 2007. But otherwise, this is the highest inflation's been running in the last 30 years. If you look at other traditional measures, so if you take this and you strip out food and energy, we call this core CPI. So food and energy tends to be very volatile, but has the same average inflation. If you take that out, it's even worse. You can see this is the highest inflation we've had for sure in the last 25 years, all the way back to the early 1990s. If you look at CPI, so CPI just came out this morning. So our inflation here in the US now is running at 5% year over year for our CPI measure. And again, if you look at CPI less food and energy, so this is just a different way to measure inflation, you can see here that the CPI is the highest it's been in almost 30 years. So there's a lot of inflation right now in the economy as everything's being reopened. Supply chains are hurting, everybody's fighting over the same stuff. And of course, everybody has a lot of money that they've been spending or they have to spend, right? So everybody's fighting over the same resources. So there's no need to fear, however, according to our government officials, because this is transitory. I have no idea where the word transitory came from. I believe the word they want to use here without sounding too fancy is temporary, is the word that they're looking for. But it's the new buzzword, transitory inflation. The US inflation is transitory. Inflation rise, is it transitory? So we're using this word transitory. And basically, this is cover for the Fed, who has a 2% inflation target, to say, you know what, it's okay, we have 5% inflation. It's only going to last a few months. All right, don't worry about it. This stuff's only going to last a few months, and then inflation is going to go away again. Right, so I just Googled, transitory inflation to see what the hell they are defining it as. So they're just saying it's supply chain disruptions, like a shortage in chips, auto sector stuff, price highs for used cars, et cetera, et cetera. And so the question is, really, is this stuff transitory, right? Is this stuff going to be a temporary inflation, or is it going to become permanent? And the one way to guarantee that we'll make sure that this is not transitory is basically if everyone has this conversation like Michael Scott had with Stanley, which is, everyone wants to have their salary go up, right? If people end up getting this embedded in their salary, then they have even more money to spend, which of course makes inflation become more permanent and more baked into the system. All right, so this is some data called the JOLTS data. All right, the JOLTS data. And so it looks at kind of like the number of job openings and the percentage of people that are quitting. So this graph here is the percentage of working people that are quitting over time. And you can see what happens is pretty much when there's a recession, people stop quitting their job, right? And obviously it means because there's no other job for them to take, right? So nobody probably was really quitting their job in March. But you can see right now we're in the anti-recession, which is many people are quitting their job. It's at a series high. All right, and there's lots of probably reasons for this. One of them is maybe people are catching up, right? There's a lot of people who want to quit their job, but didn't quit their job because they were worried, and now kind of this is a pay it forward thing. All right, but there's a lot of people that are quitting their job. All right, and so one of the reasons they're probably quitting their job is because they have better options and they're getting paid more money. This is the number of job openings in the United States. We're almost up to 9.2 million jobs opening here in the United States. Again, you can see the downtrends in the recessions here, and then you can see the big spike here. Again, you might think some of this is catch up for the jobs here that we didn't have listed during the crisis, but clearly the number of job openings as we reopen here are really high. all right, really, really high. And so the labor market, even though, if you look at the jobs report, which we'll talk about here in a minute, looks weak, the actual job market is incredibly strong right now. It hasn't supposedly hit wages yet. So this is year over year change in wage growth. So you can see your wages aren't really spiking here yet, but I think that's probably going to start happening here pretty soon, because if you look at Chipotle's raising their prices after they had a worker wage increase, surprise jump in wages happened last month. U.S. job market's growing, picking up, and people are using, desperate employees, or employers are using wages to attract employees. And of course, we can't forget about our politicians who gave themselves a nice 4.2% pay raise last week for the improving economy here in California. All right, so you can see here that I think these wages are going to start to increase across all the sectors here as people fight over jobs, right? And again, you can see here the U.S. here is desperate for workers here. McDonald's is actually giving people like Amazon gift cards if they just go apply for a job. So later on, when I get a Big Mac for lunch, I'm going to also fill out a job application and get myself an Amazon gift card at McDonald's. All right, and as mentioned, you might think after all this that we're booming here when it comes to jobs, but actually that's really not true. If you look at the data, and if you look at the data here, so this is the number of people employed here in the United States. So you can see here, we obviously had a huge drop when COVID hit, right? So we went from about 153 million jobs all the way down to about 130 million jobs in the US. That's balanced back, there we go, nicely, but you can see we're still about 8 million jobs lower than we were before COVID struck. All right, and so again, there's this weird disconnect between the number of people employed here and the unemployment rate where we were pre-COVID, and what's going on in the actual job market on the ground, all right, where the job market, people are desperate for employees, even though there seems to be a lot of people out of work. And so there's been a lot of discussion about why that is. So one thing that's been tossed around is a childcare issue, right? So women are, childcare even today falls mostly on women, or more on women than men. And so there's been this idea that women have not been coming back to the workforce because they're stuck with childcare obligations. But the data doesn't really play that out, right? So this is the participation rate in the economy of men versus women. So the rate of men is on the left and the rate of women is on the right. You can see here that women participate in the economy less. Back in the 1960s, this is only about 18%, by the way. Only about 18% of women participated in the economy back in the 1960s. But you can see here, both sexes had the same drop, or genders here had the same drop. And then you can see the recovery and participation rate's been approximately the same. So it doesn't really seem to be from women staying out of the workforce more than men. There's maybe some counterfactuals here that are difficult to prove, but the data here would actually say that's not the case. Maybe it's because of unemployment benefits, right? So if we do some quick math, the minimum wage is about $15 an hour in most places now, especially here in California. If you work 40 hours a week and that you do 52 weeks of work, that's $31,200. In California, your maximum unemployment benefits are $450. You can get an extra $300 per week now with the unemployment benefits times 52 weeks. Means you'd make $39,000 if you're unemployed, which means you make about an extra $8,000 for not working. Steve was kind enough to point out at minimum wage, probably your max benefits are $300, but of course 300 plus 300 times that gets you exactly $31,200, which means that you're indifferent in terms of how much money you make if you work or you don't work. All right, so I'm not saying that people are not working because of unemployment benefits. I don't want to make that conclusion here. I'm just saying that, for the people that think that this is the cause, there is some math that shows that, well, maybe this actually is one of the reasons that people are staying unemployed. What about people working from home? So I know myself and many other people have been doing a lot of work at home. And so I feel like many people are kind of sort of here oh my gosh, Peter Gibbons, I've been missing a lot of work, but I wouldn't say I've been missing it. And so, shockingly, workers don't want to go back to work. Right, so 42% of remote workers will quit their company if they make them go into the office. Of course, as a rational person, I'm sure that their manager will tell them good luck, because if they quit, the only jobs available will be other jobs where they have to show up in person. So they'll kind of cut their nose off to spite their face. And then there's this great article about how Apple asked their staff, or told their staff, they're coming back in September on Tuesday, Wednesday, Thursday. So they don't have to come in 3 out of 5 days out of the week. And of course, what happened was, the staff, about 3,000 people, signed some petition that said they don't want to go back to the office. And one of my favorite comments in the thread here, this is on macrumors.com, was, now we've been working home so long, they need to start adding incentives to go back, like paying for gas in transit plus commuting time. And of course, this guy says your salary includes money for those types of things. So you can see there's this big resistance to going back into the office. And I think this is going to be one of the things we really have to work on here as a society. I think it's great that people have found maybe more of a work-life balance, but I also think this idea that we're never going back into the office, just for most workers, just is not going to happen. So one of the comments has always been, well, working at home has made us super, super productive. And the data also doesn't really bear that out, right? So what happens is every time there's a recession, this is a measure of productivity here in the US, every time there's a recession, productivity goes up because a bunch of people get laid off, the existing workers have to do extra work. And so productivity has this bounce. So you can see here, this is the 91 recession. There's a big bounce in productivity. This is the tech recession. You can see a big bounce in productivity. This is the financial crisis. There's a big bounce in productivity. And actually, if anything, you can see the COVID bounce here has actually been smaller bounce in productivity than the other recession. So there's no real evidence that working at home as a society made us more productive. I'm not saying that people can't work at home or people aren't productive working at home. So please don't take that way. I'm just saying there's no evidence that working at home has made people more productive. All right, so why are we going back into the office? Well, there's a couple of reasons. So the first one is, I hate to tell you, but your boss likes to keep an eye on you. So I was doing my computer consulting business. I could have wrote code from anywhere. But when you're getting paid a lot of money, generally people like to keep an eye on you. And that's just the way society has worked for a long time. One of my friends was showing me that he bought this thing that on Amazon where it randomly moves your mouse around. So it makes it look like you're working and paying attention while you're out playing golf. So, I think bosses like to keep an eye on their workers. And right now bosses might be saying, well, where are you going? Because if you look at gasoline consumption here in the US, it's almost back to normal, even though most of us are commuting into work. And so the question is, where is everybody going in their car? And the answer probably is they're going on vacation somewhere. And a lot of that's pent up demand. So I'm not blaming people. I'm just saying, people are obviously out there doing things other than going to work when they're probably supposedly working at home. All right, so I'm going to say some controversial things, and you can disagree with me if you want. I'm going to argue that probably most people, again, not everyone. So please don't say that, well, my job, I can be just as productive at home. I'm not saying that your particular job might not be. I'm saying just in general, I think most people are going to be more productive at work in the office if they at least go to the office sometimes. I think work policies will definitely be more flexible going forward, but I'd be very surprised if most firms don't have you have to show up to work XYZ number of days per week. Companies that probably have work at home only relative to peers, and this is just my prediction, are going to have greater employee turnover. They're probably going to have less productivity. They'll probably have reduced creativity. And workers that choose to stay remote, if they have an in-person option, I hate to tell you, are probably going to fall behind their coworkers, especially when it comes to things like promotions. And reason, for a lot of this stuff is, long distance relationships really work, right? So when you have a long distance personal relationship, those things always turn out well, right? So of course, this is from Schitt's Creek. Ted and I forget her. Anyway, someone can type the name in the chat. That's fine. They break up, and of course, everyone was super sad, and he was in, Central America, Costa Rica, or something like that. And of course, everyone was super sad they broke up. But generally speaking, long distance personal relationships don't work. So why should long distance professional relationships work? All right, why should they work? Because it doesn't seem to me that they would. All right, this is not how The Office was filmed, the show The Office. Can you imagine if everyone was on Zoom? This is like your 10, 11 seasons of The Office. This is what they look like. If you don't ever meet any of your colleagues, if you don't have any personal connection to them, if you don't have to move to switch whatever jobs, you're going to switch jobs all the time. You're just going to go to the highest bidder, right? If you can just sit in the same place and someone says, hey, I'll pay you 20% more to do the same job, you're just going to go, right? You don't have anything keeping you there, no personal connections, no nothing else, right? And so I think that's why this idea of everybody just working from home probably is not going to happen, because I think people are going to be more productive in the office when they have other alternative things that they can do. And two, you don't have these personal connections to keep you going. And I think one thing that every company tends to underestimate is the cost of HR turnover, right? The cost of employee turnover is really high for every company. And I don't think we do a particularly good job at capturing that. So just to give you my personal experience, I have a colleague, we were writing a paper together, and her office is 3 doors down from mine. And so, pre-COVID, when we were working on the paper, I was stopped in the office, talked for 5 minutes, and we would have been done. But you can see here over Zoom, you can see, I'm not going to read the whole thing for time purposes, but you can see, basically you have 8 emails, a 5-minute meeting, and it took 2 weeks to get the meeting scheduled just because we're doing things over Zoom and we're remote and we're not able just to pop in each other's office and answer questions that happen. Right. So again, this is kind of the issue here that we have with productivity. A lot of times, if you have to meet people in person, it's a lot easier to do that in person than just pop in someone's office than it is as it is to do it over Zoom. And of course, remember, these pop-in random conversations are where a lot of creativity happens. You don't have that kind of creativity when everything has to be scheduled out on Zoom. In terms of getting ahead in the office, I mean, listen to Andy Bernard, right? And, he's saying it's been a pretty good day because he's getting a lot of FaceTime with the boss. I mean, at the end of the day, if your boss knows who you are and because you're in the office all the time, you have another person that's remote and there's a promotion going on, I think it's pretty obvious that, the person that's there all the time, unless you're annoying like Andy Bernard here, is going to be favored. All right, so we got about 10 or 12 minutes here to go, and then we'll get to some Q&A. So I see people put some stuff in the Q&A, so you can go ahead and start putting some stuff in there. The other thing I'm worried about, so a couple more things I'm worried about, and then we'll talk about finance and real estate a bit. I'm really starting to worry about the misallocation of resources, right? So inevitably, what causes a recession is a misallocation of resources. So if you look back in the tech bubble, everyone was spending too much money investing in these tech companies that didn't really have a future, and they were ignoring other things that we might need otherwise, like oil, because of course oil prices then spiked. During the housing bubble, we overinvested in housing, and that caused a recession. And I feel like right now, we might have some misallocation of resources simply because people are focused on the wrong thing. And our bubble, I think this time, is going to end up being in chips. We have this incredible chip shortage right now, and I feel like in 2 or 3 years, when all these new fabs come up to speed, we're going to have an incredible chip bust coming up. And I mean, the reason is there's a real issue here, right? So GM, basically they take start off their cars. Samsung here had to stop their Galaxy phones. They can't update them because they don't have the chips. You can see here, there's actually like toasters now and washing machines they can't make because there's no chips. You can see Elon here shows that there's a chip shortage, and it's affecting Tesla. You can see that it's even affecting people who might want to wash their dogs. I mean, the tragedy here is at some point it might get so bad that Golden Doodles can't get their puppy patty at In-N-Out Burger. That things are getting so bad here with this chip shortage. And one of the reasons we have a chip shortage, there's lots of reasons, but one of them is because people are buying these chips to mine cryptocurrency, right? So you can see the amount of cryptocurrency that's increased here in the world if we look at it in terms of Bitcoin. So this is counting Ethereum and everything else. If we just look at it in terms of Bitcoins up like 500% over the last 8 years, you can see a lot of that has been more recently. I mean, people are buying video cards and processors and everything else to mine crypto. And the question is that really a good use of resources when people can't buy cars otherwise, right? And that's a lot of the reasons for our chip shortage. So I'm kind of worried about the chip shortage as it's going from something that was, kind of a minor thing. I think over the next few months is going to become major in a lot of the supply chains that we have. All right, the last point here is I think things could go the other way. All right, so the one way is we get super hot and things go crazy. We have inflation, but let's just imagine things go the other way, right? And we don't have the stimulus package go through and government spending goes back down to what it was in 2019. And basically we're going to be like the hangover guys, where we're going to have the worst hangover that we've ever had or pretty close to it, right? Because all this government spending has stimulated the economy. Just imagine if all that money came away in a very short period of time. We're going to have a huge recession as the economy pulls back to go to the size it was of the government 2 years ago. And if you look, the best probably analogy, and it's a much bigger hangover. So I don't want to overemphasize this analogy here, but obviously we had a huge increase in government spending during World War II. And just to put this in perspective, government spending was up almost $3 trillion last year. So it was almost up 75% last year, government spending. And you can see what happened after World War II is over. We had a huge hangover where we actually had a lot of contractions here in GDP in the US, because of course, once all that government spending went away, then of course the economy had to slow down again. And so that's something here that we need to watch out for if all of a sudden this punch bowl does get taken away. So why is all this stuff I talked about important? We are really kind of at a point in time where we are basically the most important thing in the world is our interest rates, right? If I could sum up everything I've talked about, and the one thing that you have to keep an eye on, it's what the Federal Reserve is going to do. Because really, there's this point here where the Federal Reserve says they are not going to raise interest rates for a long time. That's the red line. And the black line is what the market thinks, right? And you can see that the market thinks that interest rates are going to start going up way before the Fed thinks that they're even going to think about putting up interest rates, right? And so the Fed thinks that they don't have to put up interest rates because, of course, as I mentioned, they think this inflation is transitory. In just a short period of time, it's going to go away. And then they don't have to worry about raising rates. And I can't emphasize how important this issue is for the economy, for financial markets, for everything, because everything right now in our economy, everything in our financial markets is tied to what happens to interest rates. So just to give you an issue, I mean, we're driving down the road here with Kermit and Fonzie Bear. Kermit, and we're going past this fork here. And on one direction, the fork's going to take us where the Fed has to raise rates soon. I mean, let's say, God forbid, that CPI hits maybe 6% in the next 2 months, which it could, right? And the Fed says, you know, we can't have 6% inflation. People are going crazy. And the Fed raise rates by the end of this year. I'm just giving you an extreme scenario. I can promise you, if that were to happen, every single asset class is going to crash, right? If the Fed stops buying bonds and whatever else they're buying, and they raise interest rates a quarter of a point by the end of the year, I can promise bonds, stocks, real estate, crypto, international art will all go out of business, will all crash, and that value will outperform growth, although both will crash, right? The economy will jolted slower, and government deficits are going to become a problem, right? So that's one. So that's what happens if inflation is not transitory. If inflation is transitory, all right, then the Fed can wait forever, and we're down this other fork in the road, right? And every asset class is going to soar in price. Just imagine that we all of a sudden got CPI to go back down to zero. I can promise you that bonds, stocks, real estate, crypto, international art, and growth would all soar in price. The economy would have a long runway, and we'd have this great 10-year probably boom, and the government can afford all that spending it wants to do, right? There's probably not a lot of in between here, right? That's the unfortunate theory. There's a Goldilocks path in between, but it's very low probability that we hit the Goldilocks path. All right, so I don't want to emphasize, I think the economy is in really good shape here for the next few months. I think what I want to do in this is talk really about kind of the next stage, like thinking out forward, thinking about what's going to happen and what things you guys need to think about or worry about as we go forward. And so really the biggest question right now in the economy is inflation transitory or persistent, right? Is it transitory and persistent? I think really the labor market is going to be the place where that shows up. Right? If inflation stands long enough where at the end of the year, people say, well, you know what, it cost me 15% more to buy meat. You know, I would like a 15% raise, and that starts happening, then inflation is going to move from transitory to persistent, right? If we can stop inflation before people start asking for those big raises, we might be safe, right? And again, that's why I'm saying there's this big fork in the road. And I've spent a lot of time talking about the kind of things I worry about, how they're going to put us down one end of that fork or the other. All right, two more things to talk about. Take questions coming up here in about 5 to 10 minutes. So it should give us 15 minutes of Q&A. Residential real estate's insane. I mean, I don't have anything else to say. I mean, it's just crazy. You know, home prices are up 13, 14% per year. Over half the homes in the United States now are closing 4 days or less after they list. In most real estate markets here in the US, there is less than 2 weeks supply of housing for sale. And so prices are just going crazy, right? There's no supply. People are trying to buy. And you can see this is a Case-Shiller index. Prices are just going crazy. If you look at year-over-year change, I mean, we're at the point where we have a year-over-year changes in real estate prices that are approaching. I'll be honest, I think probably will surpass the bubble in the next few months here in terms of year-over-year price changes for housing. And so, you know, and the reason all this is happening is because housing's still cheap. I know that's really hard to believe. I presented this, I did an econ forecast for the city managers here in Orange County, and I heard someone mumble, that can't be right. But home affordability here in the US overall, and I'm not saying just here in Orange County, I'm saying overall, is actually really cheap. And the reason is, if you go back from 2005 until today, you know, wages are up 40% from where they were back in 2005, right? So obviously that means housing prices go up 40% and you get to the same affordability. But the big thing is mortgage rates are like 7% back here, and mortgage rates are less than 3% now. Right. And so we have an incredible amount of room to run here in real estate prices just because mortgage rates are so low. In fact, if you go through and you do the math, you know, at 3% mortgage rates are actually a little bit lower than that now. To get to average affordability over the last 30 years, real estate prices go up 20% more. And at this mortgage rate, to get back to kind of bubble level on affordability or affordability, depending on the way you want to look at it, prices would have to go up 70%. Right. So housing is going to be insane here because there's lots of room to run. It's going to be insane until more people list their houses for sale. And I do think that'll start happening in the second half of the year. But again, for the next few months, real estate's going to be pretty crazy. And of course, people are taking advantage of that by starting a lot of new homes. Although, as I mentioned earlier, lumber prices are now really starting to impact housing starts here in the US. One other point on real estate. So this is again from my friend Bill McBride at Calculated Risk. A lot of people are asking about CRE. Is CRE going to start to improve? And I think the answer is yes. So this is an architecture billing index. So this is how much activity there are architecture firms. And you can see that's really hit a big number here recently. And this leads commercial real estate development by about 12 months. So I think you're going to start to see CRE development increase here as we go through 2021 and 2022. I think we're going to see some improvement there. All right, financial markets, last thing here, and then we'll do some questions. You just need to do the Zoolander right now. I mean, just do the Zoolander. You just have to avoid and not be distracted by all the beautiful meme stocks that are out there. I mean, people are just going crazy with these meme stocks. I mean, I don't really have any comments. You know, I know many of you are experiencing just the FOMO. You know, there's just nothing more than a little dash of FOMO. I was talking to one of the most rational students I've ever taught before, and even she was thinking about buying cryptocurrency just because her friends made some money. And you know, it's just amazing to see, you know, just how powerful FOMO is on people, right? So just try to avoid the meme stocks. Don't only look at them. If you're tempted, you're not alone. You know, I've taken 2 Ubers recently, and you know, both of the conversations when like literally when I'm like, what do you do? And you know, both drivers like, you know, my second job is driving the Uber, my first job is day trading. And they're like, what do you do? And I said, oh, you know, I'm a finance professor at UCI. And the response was, oh, great. And then they explained to me how financial markets work. So, you know, that's probably never a good sign when your Uber driver is, you know, thinks they're like experts on financial markets. And maybe they are, but probably not. And, you know, Jim Cramer had this statement yesterday, and I'm breaking all my rules here by having big wordy slides in front of you. But basically, you know, when it comes to meme stocks, it's exciting, it's fun, it's real. If you're going to play it, I think you can. I don't know, go to the casino. These stocks should be offered at the casino. Why are they offered at the New York Stock Exchange? And then certainly, you know, as the director of the Center for Investment Wealth Management, our mission is financial literacy education. You know, he says, we got young people coming in the market. We've got 10 million people on Reddit. They need to be educated. That's the solution. I know that's old fashioned, but I think it would really help, because I know some people feel a lot of money some people feel a lot of money has to be lost. I know people like to make money as long as they understand that it's not a game. And, you know, nobody tells you when they lost a lot of money, right? All you hear about is people's good trades. And for every roaring kitty that shows up in front of Congress that's made millions of dollars, there's probably 100 or 200 or 300 investors that have lost way more than roaring kitty has made. And so, you know, this is you know, just avoid these meme stocks. And just to emphasize this point about, you know, why these meme stocks are not investing. All right, so this is GameStop. So this is the daily return of GameStop over the course of this year. And just imagine you had $1 million in your account. On average, every day, the value of your account has gone up or down $134,000 a day. Right, that's your daily change. So every day you'd log into your account, and it would be either up or down $134,000 a day. So just to put this in perspective, I have the same y-axis here so you can see the scale, right? This is the daily returns of the S&P 500. And your average daily change would be 7,000. All right, so just to compare those two, right? This is gambling, this is investing. Investing is not supposed to be exciting, right? Investing is not supposed to be exciting. I played golf with a friend recently, and you know, they wanted to see like what a good golfer, I'm not that good of a golfer anymore, looked like. And he told me it was boring. I'm like, yeah, good golf is not exciting, it's boring, right? You hit a fairway, you hit a green, you hit you either make or miss your birdie putt, and you go to the next hole, right? Investing is supposed to be that way. It's not you're supposed to like shank 3 balls in the woods and hit some miracle shot and then make a putt for your double bogey, right? It's supposed to look like this. All right, we're off to a really good start this year. So the S&P 500 is up 15%. You can see small caps have done a little bit better. They're up about 18%. All right, so that's one thing to note here. Small has outperformed large here as we've worked our way through the year. All right, and so, you know, I pointed this out before, if you've been on some of the other sessions, how, you know, probably Dow is going to outperform Nasdaq. You know, there's this kind of outperformance gap that's been going on there. Growth versus value, there's been an outperformance gap, and certainly we've seen that so far this year. Same with large versus small, which I've already showed you. You know, values outperformed growth by about 12% so far this year. And you can see that Dow has outperformed Nasdaq by about 4, 5, 6% so far this year, right? So there's kind of mean reversions that I talked about back in October and January and March. All those things are kind of happening here in terms of financial performance so far this year. My concern is that maybe the run up in stocks so far this year and from the bottom has been a little too fast and a little too furious, right? An underrated sequel here from the Fast and Furious movies. If you compare kind of what's been going on here from the 2009 bottom, right? So this is the financial crisis bottom, that's in blue. And then you look at the COVID crisis here, which is in orange. You know, basically rolled out the same playbook when it comes to money in terms of Fed and everything else. And you can see that, you know, we're kind of getting to the point here where in the last recovery, we had a bit of a correction here in stocks. We had a bit of a correction here. So I would not be surprised if for the rest of the year, we're kind of choppy and maybe didn't go up much more from where we are today. It probably surprised me if we had another 20% run for the second half of the year here right now. Market's still expensive. Price to earnings ratios are high. I'm going to skip that for the interest of time. Nothing's changed there. The one thing I'll note is that analysts are getting more and more optimistic about corporate earnings. So this is the expected 2021 growth estimate for earnings for the S&P 500 firms. This is the date of the estimate, and you can see, back in January when COVID was the worst, the estimates were the lowest. And again, as we've reopened and COVID's improved, you can see the estimates for earnings growth this year have improved, which has been a boom for the stock market so far this year, and one of the reasons that we've done well this year. One other thing I'll just mention on the stock market is you might have heard this expression, sell in May and go away. It's really sort of kind of not true, and it kind of sort of is true. So basically, if you look at the orange line here, you can see that this is the average return by month of the stock market. And I don't really see any like seasonal pattern there, right? It's pretty flat. The one thing that's happened over time, even if you look at the orange line or the green line, which is the more extreme outcomes, you can see there's really no trend there. The only thing that you really do see is that there's been two extreme events in October. So in October 1974, there was a gain of like 18% in 1 month. And of course, we had Black Monday in 1987. And I think those are where the reputation of sell in May had to go away, or September, October being bad months. But generally, they're pretty good months. Last thing to know here, I always get lots of questions on, what about California? What about Orange County? I mean, I hate to tell you that Orange County's got 4 million people in a very diverse economy. California's got almost 40 million people. Both of those are very, very large parts of the overall economy. Both of them have very diverse economies, right? We have everything from tourism and Disneyland to high-tech firms here in Orange County. California has everything from agriculture to tourism to high-tech firms. We're the same as the country, right? So this is unemployment rate for Orange County versus the nation. If I put California here, it'll look exactly the same. If I put housing prices, a year-over-year change in housing prices, you can see that we're more extreme than the nation, but you can see our housing prices look like the nation as well, right? So there's nothing special about Orange County, California. Everything I've talked about for the country is the same as it would be here. All right, so again, get your questions in. We'll get those in 1 second here. Economy's gonna have a great year this year, no doubt about it. We're gonna have great GDP growth. Real question is, what's gonna happen to inflation? What's gonna happen to the Fed? And that's the reason I wanna emphasize that today. So start thinking about, well, the economy's good, right? Is it gonna stay good, right? Or is it gonna start to, or kind of we at the peak now of the economy, right? Or we getting that bounce back and then we're gonna come back to earth. That's what we're kind of thinking about now. And if we do have to raise rates soon, I think that has some really serious implications. So it's low probability, but huge implications if true. I still think there'll probably be some more mean reversion to the financial markets as we go through the year. I think that things will probably be a little bit choppier here in the second half of the year, just like it was when we recovered from the financial crisis. And housing is just going to be ridiculous. So if you're waiting for housing prices to go down, I wish you the best of patience. You're going to look like the Cookie Monster waiting for those cookies to come out of the oven, I think, waiting for house prices to come down. So I hope you guys enjoyed, and hopefully we got a couple of questions here, Steve, that we can go through and try to answer,
Yeah.
Or there might be some angry questions from people that want to work at home, probably.
I only saw one. Well, it had to do with unemployment. But yeah, so, great talk, great slides as usual. My takeaway from this is the most important thing probably that's going to have the biggest impact going forward is that fork in the road. Rates up, rates down, inflation, no inflation. And that's what I think probably people want to keep an eye on. I've learned, and I'm not an investor in stocks anyway, but I've learned over the years that in any market, 10, 15, 20% year-over-year returns are just not sustainable. So eventually there will be some type of correction, I imagine. What's good today is probably not so good tomorrow sometimes. But you want to be in the long run, don't want to be on that gambling.
Exactly.
You talked about. That's not
I could make the easy forecast. The economy is going to be good this year. We could have been done in 2 minutes, right? But try to be a little bit more informative. And for Alan, I believe was one of my former students, asked me if my weight has gone up like CPI. And I will admit that I put on the COVID-19 the last 15 months. So I'm looking forward to getting back to the gym.
Okay.
So anyway, what do we got for questions?
Yeah, let's get to some of these questions. So it says, do you think Jay Powell, I'm not sure what that is, but will change his stance? I'm sorry?
That's the Fed chair, Jerome Powell.
Oh, Jerome Powell, I'm sorry. Jerome Powell will change his stance given recent reports on the increase in inflation. So are the Fed going to move in the next 6 months or so, or are they going to hold the course?
So that's the question, right? I mean, I think the Fed has started to slowly get the market ready for some kind of move, right? So they sold all their corporate bond ETFs that they were holding. They've been kind of talking about maybe slowing down asset purchases. So I think they're trying to prep the market a little bit for the fact that, this isn't going to go on forever. But I think it's going to take some really kind of like turning points, or tipping point, I should say, for the Fed to really get aggressive here. I think they're going to use every excuse to say, well, it's only been a couple of months, and we're making up for inflation that we didn't have. We had deflation for a few months last year. We're just making up for it. But I think if we're coming October, November, and we're starting to run 5-6% inflation still after 5 or 6 months, it's going to be really hard for them to ignore, right? And that wage number is going to be the one to watch. If that wage number starts going up and we start things getting baked back in, that cycle, then that's going to really become a problem for the Fed.
Well, with those 8 million people still not employed, to get us back to where we were, I mean, there's got to be a lot of depth there for people to hire and still not trigger major wage inflation, I would think, right?
Yeah, I mean, the issue with the issue with the people that are unemployed is I think there's a pretty big mismatch between. So I think there's two issues, right? So the people who, for whatever reason, there's people unemployed, and there's definitely jobs for those people that they don't want to take, right? If we look at the restaurant industry, if you look at the people that are unemployed, probably most of them were originally in the restaurant industry, right? And they're not going back for whatever reason, and people can make it they can't find the right job, or they can make it that they don't want to go back because they make too much unemployment, whatever they want to do. But I also think that a lot of the jobs that are out there, there's a big mismatch between the skills of the workers that are unemployed and the skills that the employers need. And I think a lot of that is the issue with unemployment. So
maybe more of a structural thing than a
exactly, yeah, it's a structural problem. And then I think a lot of the restaurant jobs, unfortunately, aren't going to come back. It's a lot cheaper to have a machine that customers use to put in your order than pay someone at McDonald's $31,200 a year to take your order, right?
Yeah, well, I was watching a video of a robot that was flipping hamburgers and putting them on the bun. So, if McDonald's decides to implement those, we're going to need a lot less restaurant workers. So let's move on. So, well, just following up on your answer to the question. So if I have a mortgage that I haven't refinanced yet at, say, 4%, I still probably have a few months left before, I'm going to be out of luck.
Yeah, I wouldn't waste too much time though. Definitely, I think it's a good time. Mortgage rates are low. The T-bonds have come down from almost 1.8% to 1.5%. So if you want to refinance, I would definitely encourage you to do so. As far as I know, I don't know if this is still true, but I remember a few months ago, it was like 3 months to get refinanced from once you started the process. So if you want to refinance, I would definitely encourage you to get that process going ASAP.
Yeah, there was a lot of loans going through the pipeline all at once, and it just kind of jams it all up. So our next question here, it's sort of an inflation question as well. We kind of touched on it, but transitory inflation, how long and how far do you think or predict it will be in transit? So just a 6-month thing or a 6-year thing?
So I think so if I knew that answer, I would come out and tell you, like, it's going to be 3 months and we're done and you don't have to worry about it and you should buy ARK and growth stocks and everything else. It's hard to predict, right? If I could predict it, I'd probably have a different job at like Goldman Sachs or something. My opinion, this is just my personal opinion, I think a lot of these shortages that we're talking about are not easy fixes, right? I think a lot of these are not easy fixes. And I think a lot of the issues are probably not transitory, right? So I think the chip shortage, you can't build a new chip fab in a short period of time, right? It's going to take a long time to get those fabs up and running, right? So if the chip shortage is more demand driven than supply driven, it's going to take a long time to get that supply caught up. It's like kind of like housing, right? So if you have an area that need houses, it takes 2 or 3 years to kind of catch up with the houses, right? You can't just snap your fingers and tomorrow there's houses. The other thing that's important to note here is that Asia, doesn't really have a vaccine going on, right? They're not like here in the US, they'd use a very different strategy. And you can see, China's got some new lockdowns and Japan's got a lot of problems and Taiwan's got a lot of problems. And so you have a lot of supply disruption still. I was talking to someone about shipping from China, and the problem is it used to cost, $2,000 to ship a container from China. And now it's almost 15, 16, 17,000. And part of the reason is they quarantine the crew on both sides for almost 2 weeks, right? So if you think about, how much shipping capacity is used up there, it's a lot. So, I think these things are going to go on longer than people think. The one thing I will say is that coming up, we have a fewer higher inflation months from last year that are going to roll off. So a couple months coming up, we had inflation like 0.6% for the month. And if we had the same numbers we had this month, basically it'd stay the same, right? So we'd have to have 5.5, 0.6% inflation per month to stay where we are, which I think probably we will. But if you note recently, like oil prices really haven't spiked up that much. And so It's going to be, I think probably for 2 or 3 months we're there, and then we'll see what happens with wages. I think that's the big question.
Okay. Well, once we get through the summer driving market, gas prices hopefully will come down. There's a question here from Keith Winston talking about crypto. I know it's your favorite subject. I always like to touch on it because I like to see the expression on your face when I mention it. But his question asks, does crypto have any other use than to pay ransomware? Which we've seen that done twice in the last week or so, I think. When in one case they outsmarted the guys on that pipeline and got the money back, but the meat guys didn't do so well. But going past that a little bit, is there a place in your investment portfolio for cryptocurrency, or I
guess I can make lots of comments on crypto. So I'll just keep it easy. If you look at the days Bitcoin does well, it's typically days the stock market does well, right? So if you do a scatter plot between the Bitcoin rate of return on one axis and stock market on the other, I mean, the slope is basically one. Right? It's just that Bitcoin's more volatile than the stock market. So I don't really think of Bitcoin as a diversifier of your asset portfolio at this point. It basically moves lock and step. I mean, just think about last year. Market crashed, Bitcoin crashed, right? Market's been rallying, Bitcoin's been rallying. It's really not a diversifier. It has almost no correlation with gold. So if you think gold and Bitcoin are the same, they couldn't be more different.
Well, I think the correlation is with Elon Musk's Twitter account, isn't it?
That is true.
His level of Twitter activity is directly correlated to the price of Bitcoin and Ethereum.
That's right.
So, all right, well, let's move on. I've needled you enough on that. What about, you didn't really touch on other commodities like gold and silver.
I have some gold miners in my portfolio personally. So, not too much. I mean, I have some gold exposure out there. Gold is kind of forward looking a little bit. So, the price of gold will start to go down before interest rates go up and vice versa. But, I think if you want to get away from, the one thing I'll say is most commodities are very uncorrelated, right? So if you look at copper and oil and gold, the correlation between that's almost zero, just the way it works out, right? So copper's been going crazy and then now gold's not really doing anything. So if you want to own commodities in your portfolio, you have to own a few, right? Otherwise you might miss the boat on one or the other. So, but I do have some gold, and I have some oil plays in there. So I have more kind of the real asset stocks in my portfolio, which we've kind of talked about. More Dow stocks than Nasdaq stocks for sure.
Okay, great. Amber Wallace here is actually I should go back. Sakita Chuk, who I know, and make sure you keep those banner polls for me, Sakita. She said that Alexis was the woman in the office.
Yeah.
There you go. Okay.
Yeah, a lot of people had that on there for Schitt's Creek.
Schitt's Creek, sorry, yeah.
Yeah.
Great show, by the way. So let's move on down to Amber Wallace. Says, we talked about lumber and new construction, and what do you expect to happen in residential with pricing so high? We already talked about that, but we haven't really talked about the commercial real estate side of things. I mean, there's been a lot of talk about, especially in the past year with the movement accelerated towards online. What is Main Street going to look like? Commercial real estate. I know industrial is super hot, but that's servicing the online, the last mile and all that, and the distribution centers. But what about commercial real estate?
Well, there's a lot of different kinds.
Put office in there too, retail.
So there's a lot of different kinds of commercial real estate, right? So you mentioned industrial, right? Obviously, storage units have been doing well. You have apartments which are doing well. So if you take those away and you get to, I think what people are asking about, which is malls and office space. In my personal opinion, I certainly. I don't believe office space is probably as bad as most people think. That, again, you can see my personal opinion is that we're going to end up way more work in the office than other people think, right? My personal opinion is it's probably not going to happen overnight, but it's going to start to happen. Apple's putting people in, Netflix's people, even these tech firms are putting people in where you could argue that, well, a programmer doesn't have to be in the office. And so I don't think office space is going to be that bad, but I think probably with the capacity that's out there now, I'm not sure that we need to build that much on the office space side of the house. The retail, I think, I think that there's been a huge acceleration in the retail side. I think a lot of restaurants are going to move back in that probably have gone away. I think those are going to come. I think Americans are always going to go out to eat, right? We're always going to go out to eat. We're too lazy to make dinner at home. We got too many, both parents working out, they're not going to have time to make things at home. So I think that's going to recover, but I think a lot of retail is probably gone, right? Unless it's something that you feel like you need to try on, or unless you're a big brick and mortar store like a Best Buy or something where you have enough product, enough volume to stay alive. I think those are gone. And I think here in California, a lot of people have been talking about taking those old malls and knocking them down and putting in housing, right? Because we have all these houses we have to build and no place to put them. So I think that's probably a lot of malls are going to slowly especially in more rural America, are going to get converted over to housing.
Yeah, well, I know certainly in Newport Beach, and I know all the other Orange County cities all over California are fighting now with the state over how to allocate or plan for, literally millions of housing units, and everybody's eyeballing these underutilized or potentially underutilized commercial properties for redevelopment, because in a city like Newport Beach especially, we're built out, and shopping center that's not performing when average home costs $1 million.
Yep.
You start thinking about bringing the bulldozer in and building something else.
That's right. All right, maybe one more last
yeah,
one.
Last one. Let's go. Okay, well, how about this one here with Maxwell Rhinelander? It says, considering that most minimum wage jobs do not pay a livable wage, how can we position ourselves to incentivize workers to seek out jobs and careers as opposed to staying on unemployment benefits? So how are we going to get these people out of their homes and a job and a career that's going to make more than $30,000 a year?
So, well, if I had the answer to this one, I could probably work for the government somewhere. But, so I'm gonna sound old here. I'm gonna go with the old school. When I was young, I'm gonna start this answer when I was young. When I was young, most minimum wage jobs were done by teenagers. Right. So my first job, I worked at a grocery store. The day I turned 16, my mom drove me down to the Big D in West Boylston, Massachusetts. And I worked as a frozen food stock boy, which was the worst job I ever had. I couldn't feel my hands for an entire summer. Anytime someone asked me if I wanted to get ice cream, I was like, hell no, I don't want ice cream. And so, of course, I learned so much. I always tell parents, I think that having a job teaches you a lot, right? It teaches you about responsibility and having a schedule. And I think one of the things I learned young was the difference between a good and a bad boss, which is, I learned that immediately, right? My first two jobs, what was a good and a bad boss. But, minimum wage jobs are not supposed to be living work jobs, right? Minimum wage jobs are supposed to be jobs where you get work experience, and then you move up to the next job. I don't mean any disrespect to anybody, but I don't think that people really think about being a cashier at a Jack in the Box is really supposed to be a career. Right? That's not supposed to be a career, right? That's supposed to be something that jumpstarts your career, gets you that work experience to go to the next level, right? So, I went from, working at a Big D shopping market to a hardware store. And then I started doing like part-time computer work because I knew about computers, right? It's to move you up in the world. And so I think a lot of everything we talk about is always about education, right? They're always about education. And, that's one thing we work on at the centers. We have a program called Life Fest that tries to get kids to be the first in their families to go to college, right? Because the thing that moves you up is you have a skill set. And so that usually comes through education. So I don't have a magic bullet to get people to work. I try to be optimistic, and I think that most people want to work. But I'll be honest, if you offered me exactly my pay not to have a job, even I would think about not coming to work, right? Who wouldn't want to play golf or do something else all day? I've never quit my job. I love my job, but I think that's the basic point, is that I think these benefits go away. I think that a lot of people needed the benefits. And over time, we're going to see, right? We're going to have a case study here in September, all Labor Day, right? They all go away, and we're going to see what happens to these minimum wage jobs and see if they get filled or not. But, I just think this idea that a minimum wage job is supposed to be a permanent job for life is not really the way the system was set up. In my personal opinion, I think the idea is that gives people experience, and then we educate people. That's why I have a public school system. And then those people get better jobs than minimum wage jobs, right? And then, and then it just keeps filling in. And so, that's my argument to the whole thing. I'm not sure that's a political statement or not. I'm not trying to make a political statement. I'm just trying to tell you my view. I don't think anybody thinks that a Jack in the Box cashier is a job that you're supposed to have for life and be able to live on for your whole life. Well, and maybe I'm wrong on that. So, but
there's a few people who think that could be a potential job that way, but I would 100% agree with you. I think education, skill building, acquiring skills so that you can move higher up the food chain and have a better job, more benefits, and more security is is really the way to go. That's how we're going to get out of this, this crisis. And so with that being said, there's a whole bunch more questions. I'm sorry we don't have enough time to get to them all, but thank you all for attending. Chris, I definitely want to thank you for giving us your time. And great presentation as always, great information. I do want to remind everybody that if you missed it in the beginning, October 5th will be our in-person live economic forecast for 2022, as presented by Chris, our forecaster and Bitcoin prognosticator. And at the Balboa Bay Resort, October 5th. It'll be a luncheon. There'll be more information available as we move into the summer at newportbeach.com. We'll be emailing all of you anyway, since we've got all your email addresses. Chris has always made the video available, so we will have the video maybe later this afternoon or tomorrow. And I believe you've also provided the slides as well. Some people have asked about that. So we will be providing the slides, the link to the slides. So if you miss something, you can catch it then. I don't know that we're going to be planning any more updates between now and October.
I think we're going to give you guys the summer off. If obviously something crazy happens, we'll be back. Yeah. But otherwise, no, I think on behalf of Steve and I wish you guys an absolutely great summer. Enjoy your freedom. Don't be too scared. Enjoy your freedom. Be smart, but enjoy your freedom. And
get vaccinated.
Yeah. And thanks for tuning in. It's been a lot of fun to do these. And so we'll see you soon. Looking forward to seeing some of you in person in October. It'd be great to see some of you in person. So. Take care, everybody.
Very good. And I want to also thank all the co-sponsoring chambers for putting it out. We appreciate your participation, and we'd love to see you all in October as well. Thanks.
All right.